We'll talk about these 5 modules. First, we're going to talk about the topic of corruption in general. Then we'll talk about bribery. And then we're going to talk about the international context with both the FCPA and the UK Bribery Act. And then module 4 will cover illegal gratuities, economic extortion, and conflicts of interest. And then finally, the human factor when it comes to corruption. Okie doke. So the big 4, if you will, corruption schemes are bribery, illegal gratuities, economic extortion, and conflicts of interest. So a corruption scheme, and this is a very legalistic definition, pretty much legalistic. Bribery may be defined as and here are the big 4, offering, giving, receiving, or soliciting anything of value to influence an official act. So first off, I want to talk about those 4, offering, giving, receiving, or soliciting. So you can be charged with bribery or be guilty of bribery on either side of that transaction. If you are the person giving the bribe to the official, and again, when we say official, it can be, mostly we're talking here, corporate officials. It can be a corporate official. It can be, we usually think of bribery, you think of a government official. But corporate officials can also be involved with bribery when they are essentially selling out their fiduciary duties. But again, either side, the person giving the bribe or the person receiving the bribe can be guilty of bribery. But notice the actual bribe does not have to change hands. Simply offering a bribe is bribery. The soliciting, asking for a bribe, is bribery. So I know down there in our Hall of Governors, we have a bronze plaque there for former Governor Rod Blagojevich. And part of his defense when he was charged with bribery was he never got any money. But frankly, that's irrelevant to the law, because the law says if you solicit, which apparently a jury found he did, but even if you didn't receive the money, you're still guilty of bribery, or can be found guilty of bribery, and that's what happened in that situation. Now, there are 2 other parts of this definition of bribery which often come into play, and one is anything of value. Okay, and there have been any number of cases involving, well, what exactly is this anything of value? It can be all sorts of things, and we'll talk about those in a moment. And the other is to influence an official act. And again, this is the cases have gone to the Supreme Court to determine what is an official act if you are a business or government official. Okay, and it says the term official acts means the traditional bribery statutes prescribe only payments made to influence the decisions of government agents or employees. So, but again, it has been extended to commercial bribery as well. And so so generally, when we just use the term bribery, we're talking about bribing government officials. When we use the term commercial bribery, this is for a company official, something of value offered to influence a business decision rather than an official government act. Okay. Then you have illegal gratuities, similar to bribery, except that something of value is given to an employee to reward a decision rather than influence it. And this was a matter that went to the U.S. Supreme Court recently. I'm trying to remember which town it was. think it was Portage, Indiana. The mayor of Portage, Indiana was charged under that, essentially charged on the same statute, federal statute, that makes bribing a government official illegal. And apparently, a company that sells garbage trucks bribed the mayor, gave him payment, but they paid him after the city had already purchased the garbage trucks. And so there were two arguments made in his defense. Number one was that actually they were not paying him a bribe or an illegal gratuity. They were paying him a consulting fee, and that's how they deemed it in the paperwork. It was a consulting fee. They were, the mayor was consulting with this garbage truck company that from whom they bought, like the city bought like $1 million in garbage trucks. And the other argument was that, well, even if he took this money, and even if it wasn't a consulting fee, it was a illegal gratuity. It was a gratuity. It was paid after the contract went through and the garbage trucks were delivered. And the statute under which he was charged only covered bribes. That is to say, a payment made in advance or something of value in advance to influence the decision. Well, the prosecutors attempted to argue that, well, wait a second, we think there was a promise that they would pay this money after the contract went through, but apparently no evidence of that ever went into the trial. And so the U.S. Supreme Court said, yeah, under the federal statute in which they charged this mayor, illegal gratuities or payments made after the contract are not illegal. And so I actually went around and did a couple of speeches called, when are illegal gratuities not illegal? And so it's still up in the air on that. I think the Supreme Court was hoping that the Congress would amend the law in this area. They have yet to do so, as far as I know. And so we'll talk about more of that later. Then we have economic extortion, which very often when, and again, I saw this when I was, those couple of years I was working in the federal court in Chicago. A lot of the politicians that were charged not so much with bribery, but extortion. So it wasn't so much a company came to the government official and said, here, I'll give you, $1 million if you place this contract with my company. It was more the government official saying, hey, I see you want to expand your business. Well, you're going to need a permit to do that. And, I may not want to issue that permit unless you make it interesting for me. Okay, so it's a pay up or else. So it's the official essentially saying, you pay me or I will not allow whatever change in the zoning or whatever it takes, whatever official act is necessary for essentially your company to survive. I'll essentially put your company out of business unless you pay me. So that's an economic extortion scheme. And then a conflict of interest occurs when an employee, manager, or executive has an undisclosed economic or personal interest in a transaction that adversely affects the organization. So, if your spouse is an executive in the company and the company is, up for getting a large contract, and you see to it that your spouse's company gets that big contract, in so doing, your spouse gets a big bonus. Yeah, that's a conflict of interest. And we'll talk about how, in many cases, it's easy to address that. All right, so let's talk about bribery. Number one, it has to be something of value. Case out of the Supreme Court out of Virginia, where the governor some years back was charged with bribery for saying, well, he was, it had to deal with, having access to the office of the governor. And the Supreme Court said, well, that's not really something of value. That is something that, politicians do. And it was an interesting opinion. So every now and then cases go to the Supreme Court, bribery cases, where the question is this something of value? We'll talk about that in a moment. So the classic case is the under the table payment, the cash in a brown paper bag for the exercise of influence over a business decision or a governmental decision. Again, just offering a payment can constitute a bribe. Requesting a payment can constitute a bribe. So as simple as, the traffic cop pulls you over and, he asks for your license and registration or license and insurance card. And in between them, oh, look, you just happen to place a $50 bill. That could be considered soliciting a bribe, or offering a bribe, rather. Offering a bribe. On the other hand, if the police officer says, be really terrible seeing your record if I issued you a ticket. Oh, by the way, you see this pen I'm using? It's a really good pen. Would you like to buy it from me? It only costs $50. That's essentially soliciting a bribe. So again, even if no money changes hands, soliciting or offering a bribe constitutes bribery. Two of the big categories of bribery are kickbacks and bid rigging schemes, especially in the area of commercial bribery. So a kickback scheme can include submitting invoices for goods and services that are either overpriced or completely fictitious. So you have collusion going on between the employer, between the company official and the vendor. So the vendor submits an invoice, either overpriced goods, or non-existent goods. What happens then, the salesperson, the vendor, wants to place the contract, places the contract for a, inflated amount. Maybe the goods are delivered, and that excess money is then kicked back to the company official. Okay, that's the name kickback. It almost always attacks the purchasing function of the victim company. Okay, it's more common when the purchasing decisions are ultimately made by one person, such as the head of the purchasing department. I had a fun job between my first and second year of law school, summer job, working for a government agency where a couple of months before I was hired, the FBI swooped in on this agency because apparently the head of purchasing was in fact taking kickbacks. And the FBI, as FBI does, it swooped in and it brought in a moving truck and all these agents and essentially grabbed up all of the paper files, all of the purchase orders, all of the invoices, all the receiving reports, and just took them back to FBI headquarters. My job, and as a result, of course, it's good accounting practice that you don't pay an invoice unless you have, attach the invoice, attach a purchase order and a receiving report, and sometimes also attaching a requisition report, a requisition request. Well, all of them were down at FBI headquarters. And part of my job with this agency was to put together all of the invoices that needed to be paid and but could not be paid because the FBI had all that paperwork. And then I would walk down. At that time, the FBI was located in downtown Chicago. I'd walk down Dearborn Street to the FBI, to the Dirksen Federal Building, and go up to the floor where the FBI was, and say, "Hi, I'm with this agency, and I need to get these receiving reports and purchase orders so that our vendor can get paid." Because a lot of vendors started saying, "Hey, we're not going to supply you with any more stuff until you pay our old invoices." And the excuse of, "Well, the FBI has our paperwork," the FBI ate our papers, didn't settle well with these folks. So I was, daily walking down to the FBI to get the paperwork, or every other day maybe. But it was an interesting summer job. Anyway, and it turns out that the guy was in fact taking kickbacks. Just let you know. All right. So here's our kickback scheme schematic, if you will, our flow chart. It's in the text. I'll let you look at it there. Okay. So again, part of the idea is to divert business to the favored vendor. And why are they favored? Because the vendor will be giving a kickback, paying money to the person in purchasing. So you're directing excess business to a vendor. So there might be no overbilling involved. So you don't necessarily need overbilling, but you're just saying to the vendor, "Hey, I know that you need some business. Maybe you're a new company, and I'll send you, a lot of business. Okay, but I want something in return." Okay, so I will guarantee you a steady stream of business with every company wants. We'll buy all the whatever it is that we need from you, but in return, you will pay me X amount a month or 10% on the sales, whatever. Because these transactions do not require the direct payment of cash, they can be particularly difficult to detect. Okay, so it's and the vendor is not subject to economic pressures. So vendor is happy, and ways of getting there's not excess money involved, but nonetheless the official will be getting some. Now the overbilling scheme, if you have that, so the last scheme, you don't necessarily need an employee with approval authority. They're just doing their job, but they're making sure that that favored vendor, and favored meaning the one that will give you a kickback, gets the business. Now, the overbilling scheme, it works if you have an employee with approval authority. So the true kickback schemes begin as overbilling schemes. The ability to authorize the purchases and thus authorize a fraudulent purchase, either overpriced or non-existent, is usually the key. So the vendor submits the inflated invoice to the victim company. They either overstate the cost of goods or services or reflect a fictitious sale altogether. The employee, signs off his or her approval, and the money is paid, and then the kickback ensues shortly thereafter. Now, what if the fraudster does not have approval authority? Well, the lack of authority simply makes the illegal activity more challenging. So when an employee cannot approve a fraudulent purchase themselves, they can still orchestrate a kickback scheme if they can circumvent purchasing controls. So in less sophisticated schemes, the corrupt employee might simply take a fraudulent invoice from a vendor and slip it into a stack of prepared invoices, and then they go through. Okay. Again, kickback schemes are often difficult to detect because you are not, it's simply manipulating the existing accounting system. Other schemes. We have outsiders seek other fraudulent assistance from employees of the victim company. And in other cases, bribes come from potential purchasers who seek a lower price from the victim company. So this is flipping it. So this is the salesperson rather than the purchasing manager, okay, purchasing inflated goods for the company. Here you have a salesperson for the company giving discounts to a customer. The customer gets a lower priced good, and then, so let's say they give them a $1,000 per unit discount, and then that salesperson gets $500 back. Okay, the customer gets $500 in discount, and the salesperson gets $500 in cash, but the company is out $1,000 per unit. Now, sometimes bribery schemes go on without the bribing company, if you will, knowing what's going on. So you've got a salesperson for that outside vendor who's worked up a kickback scheme with the victim company, where the purchasing manager of the victim company is approving, inflated invoices so that the salesperson at that vendor company can pay a kickback to that purchasing manager. Now, the vendor company, the company higher ups may not know this is going on. You've got that salesperson who's wants to make their sales figures look good. So how do you handle this? How do you, over on that vendor's company side, what do you do with this excess money coming in? And how do you get that cash going back to that purchasing manager in the victim company? So you create a slush fund, a non-company account from which the bribes can be made. So that employee must first divert company money into a slush fund. The key to the crime from the briber's perspective is the diversion of money into a slush fund. So that money comes in, and the employee of the vendor company has created some sort of fund for paying often consulting fees. Aha. Well, guess who's going to get a consulting fee? Well, it's that purchasing manager over at the victim company. All right. How do you prevent and detect kickback schemes? Number one, separation of duties, right? Separate purchasing, authorization, receiving and storing goods, and cash disbursement duties. And I see someone just entered our little soiree here. So let me I'll put you on the attendance sheet here. Okay. All right. And go back to the slide. All right. All righty. Here we go. Okay. Maintain an updated vendor list so that suddenly a new vendor shows up because that's the bribe paying vendor. Review and match all support and disbursement vouchers. Routinely monitor prices paid. So if you suddenly see that we're paying an inflated price for something we've been paying a lower price for a long time, what's causing that? Monitor trends in the cost of goods and services purchased. Establish price thresholds for material purchases. So we're not going to pay over this amount. And if they're trying to do that, they're going to have to go through an approval process. Track purchase levels by vendor. Check the quality of goods delivered. Often, one of the ways you get around a bribery scheme is to supply lower quality goods, but at the premium price. had this case some years back with the U.S. Air Force, company supplying, actually Defense Department sees this several times, either low quality goods or non-U.S. made goods, especially for Department of Defense. They want to make sure that the stuff is made in the USA. And if it's not, that's a violation of the rules. But you'll have purchasing people having stuff relabeled and other things so that they can get that bribe. Compare the actual expenditures to budgeted amounts, review organization buying patterns, a right to audit clause. That's a wonderful thing. Is that when a purchase order is sent to the vendor saying, hey, vendor, we need to buy, $2.5 million worth of your stuff. On the back of that purchase order is all sorts of, legalese and, as we say, boilerplate language. Included in there should be a right to audit clause that says, oh, by the way, if we suspect, or really for any reason, but the idea is we suspect there might be a kickback scheme going on, you will allow us to send auditors to your company to look at accounting records at your company. Okay, so we're going to audit the sales paperwork at the vendor company to see if there might be a kickback scheme going on. So the right to audit clause is really nice. And then if they refuse, well, then they're breached their contract, and the contract can be thrown out. And again, establish written policies prohibiting acceptance of gifts or favors. We'll talk about that a little bit later. And how that affected me some time ago. Okay. A bid rigging scheme. Okay. So I have inside influence in the competitive bidding process. So most companies or government agencies say, okay, for any purchase that we're going to make over, what have you, $100,000, unless there's some, emergency or what have you, we are going to place it out for bids. And we'll say we're going to solicit bids. So any company wants a bid on this project, submit it. And if you can meet the specifications, then you get the contract. Okay. If you are the lowest bidder. So in the competitive bidding process, all bidders are legally supposed to be placed on a level playing field. Now, a bid rigging scheme we can categorize based on where in the stage the fraudster exerts influence. The pre-solicitation phase, okay, even before they're soliciting bids, this can occur. During the solicitation phase, and then during the submission phase when those bids are being submitted. So here's our flow charts for that. Okay, so let's talk about how this takes place. Now, even before you even send out that solicitation, that you're seeking bids on a project. Let's say I'm going to put in the government arena again. Let's say some town, a suburb, decides that they need to build a new high school. Very good. So maybe they do, maybe they don't. But the superintendent of schools has somebody who's come to them and said, look, if you authorize the building of a new high school, that'll cost millions of dollars, and I'll make sure that you get an extra $1 million. Or that superintendent goes around to some contractor and says, oh boy, I have the authority to authorize the building of a new high school, but I'm really kind of hung up, and I really would love to retire early, but I need at least $1 million to do that. But I'd like to, before I retire, I'd like to to set up the contracts to build that new high school. Okay, so you're soliciting the bribe. So again, this is the pre-solicitation phase. So there's the need recognition scheme. So maybe there's not a need for a new high school. Nonetheless, it gets built because the motivation was getting a bribe to that superintendent of schools or whatever the office is. So the employee of the buyer recognizes a need for a particular product or service. And again, it doesn't have to be a whole high school. It could be, we're going to need new laptop computers for everyone in the company. Well, maybe you don't. Or maybe you don't need, the top end ones. But nonetheless, that's what you're going to do because you're either, soliciting a bribe or you received a bribe. Okay. You don't really need those new computers, but we're going to order them anyhow. The victim company then purchases unnecessary goods or services. So how does this work? Well, the fraud scheme is tailored, the tailoring of specifications to a particular vendor. So you say, for example, oh, we're going to need a new laptops, and we want, laptops that have, and then you put in all these different specifications, and for the computer, for the RAM, for the maybe the printers that go with it, and all sorts of other parts, add-ons and such. So you get all these peripherals, and oh, gee, would you look at that? There's only one company that can provide all of those things that we specified. Oh, well, I guess the contract's going to have to go to them. Okay. Or to cut down on the number of bids that you get from companies that simply would never win the bid, who are not qualified for it, you have a pre-qualification procedure where the bidders, their bids come in, and then a select group or simply one person goes through and says, no, you do not qualify, okay, to send in a bid. Sorry. And what do you know? You're down to, well, I mean, you're still going to have a few qualifying. One will be the one that you favor, and the others will be folks who submitted bids that are way out of line or way too much. Other competitive bidders you have disqualified, but you keep the one that the favored vendor, and then also ones whose prices are way too much. Or you justify it through sole source or non-competitive procurement. So, as I say, if it's an emergency situation, if your town is hit by a huge blizzard and you need to, get snow plows and salt and things like that. Well, if it's an emergency situation, you're not about to say, okay, well, we're going to send out a solicitation for bids. We'll get the bids in 30 days, and then we'll determine, who has the best bid, blah, blah, blah. No, you can't wait 30 days. You need the stuff now. So you go out and you get, you justify it through, a sole source justification due to the emergency. Now, if there's no emergency or, some other reason, we see this sometimes with accounting and legal services, that this law firm got the contract. We didn't put it out for bidding because there's only one law firm who's qualified in this area of the law. Well, that may be true or not true, but that's the justification you give for giving that law firm the contract. You write deliberately vague specifications, okay, such that some of the, shall we say, honest bidders will be including in their bids a lot of stuff that's not necessary, okay? And then when it comes time to determine the winner, your favored bidder was told what things would not be necessary and didn't include those in their bid, and they end up with the lowest bid. So like a high school bidding, you might say, well, we might want to put in a horse stable because we want our high school to have a polo team, and we want to have a wet bar for the faculty. And then when it comes time to accept bids, you're going to eliminate those requirements. And what do you know? Your favored bidder, who you let in on the secret, didn't submit anything on those. He ends up with the lowest priced bid. Bid splitting, that's where if a company says, or agency says, you have to send something out for bidding if it's over $100,000. Okay, so you send. So rather than having a, you need 200. Let's make it. You need $150,000 worth of stuff. Well, you could send it out for bidding, or you pay your favored company or give them the contract for an $80,000 contract this week, and then next week you give them a $70,000 contract. Thus, you don't have to send out the bid. Neither of those were over 100,000. That's bid splitting. And then allowing the favored bidder to see the bids being submitted by the competitors, so they can tailor their bid so that they end up as the lowest bidder, and they thus get the contract. Okay. Solicitation phase schemes. Again, you restrict who can compete. That gives the corrupt vendor better chances of winning the contract. Bid pooling. This is a way. It's a scheme where you get a couple of different bidders who get together and say, "Hey, look, one of us could get a real nice contract, or all of us could do okay." So bid pooling is a process by which several bidders conspire to split up contracts, ensuring that each gets a certain amount of work. Okay, so this is really a method of the contractors against the victimized company. There was a scheme that took place in the city of Chicago some years back, where if your car gets towed down to the city pound, and if you don't come and claim it within a specific amount of time and pay the tickets on it, they will put your car up for auction. And what was happening was essentially the same four folks would come down to the auto auction and bid on these cars. And so they worked it out so that so if there's like a brand new Mercedes-Benz being bid on, rather than running up the price to what would be a market price, they worked it out that bidder A would get this one and would pay no more than, say, $2,000 for it. And then the next car might be worth $20,000. Well, bidder B will win that one because all the others will stop bidding once they reach $250. Okay, so it's a way that the bidders can victimize the company. Other methods: restrict the time for submitting the bids. So you put out the solicitation for bids on December 31, and you expect the bids to be in by December 26. A lot of companies will say, look, we're not working over Christmas, we're not working over the holidays, we'll let somebody else have it. Well, that other company that will get it was already tipped off as to it and already had their bid ready to go in before the holidays. And the other is to solicit the bids in obscure publications. Again, the idea is you solicit bids. You can mail out the solicitation for bids to everyone in your area that's in that industry, or you publish it in the back of a newspaper of general circulation. Well, what's a newspaper of general circulation? Is it the Penny Saver in Naperville? Probably not. But you put it there, you go, yep, we published the bid and we only got one, published the solicitation, we only got one bid. Oh, well, look what happened. Okay. The submission phase In the actual submission phase of the process, several schemes may be used to win a contract for a particular supplier. The principal offense tends to be abuse of the sealed bid process. Okay, the bids are to come in a sealed envelope, and when they're received, they're to be time stamped, and then they're all opened up at the same time. In Cook County, if you go down to the county building, just outside the county board chambers, there's this big, it looks like a big ballot box, and that's where you submit your bids. There's a timestamp there, so you seal your bid, in a manila envelope or whatever, put in the little machine that stamps the date and time that you're dropping it in the box, and you drop it in the box. And then supposedly, when the date and time comes to open up all the bids, you pull out all those envelopes, make sure that they were all submitted before the deadline, and then whoever submitted the lowest bid, who meets the specifications, gets the contract. Okay. Vendors also bribe employees of the purchaser for information on how to prepare their bids. So it's like, well, tell us what you're really looking for, and we will, submit those. And if there are things that you're probably not going to eliminate, tell me what those are, and I will, put in lowball numbers so that my overall price will actually be favorable to me. Other reasons, ensure the acceptance of a late bid. For example, you go down to that box at the county building when no one's looking, you date stamp an empty envelope, and then you bring it back. And then after the deadline, all of those other envelopes are opened up, and you get a phone call. The lowest bid was, $2.5 million. That's when you put your bid for $2.49 million in the envelope, seal it up, and then you slip it to your friend down at the county building. And what do you know? Here's an envelope dated before the deadline. It had the lowest bid. Okay, so you get that late bid in. You falsify a bid log as to when bids came in. Extend the bid opening date or control the bid openings. All right. How do you detect or prevent these things? Monitor price trends. One of the ways of doing this is you have your favored vendor submit a ridiculously low bid. They get the contract. But then you have the authority to authorize change orders. So after they get that low bid, on the East Coast, they call this making it well. So, all the other folks are bidding around $2 million. The favored guy submits the bid for, 1.85 million, gets the contract, then immediately starts sending in change orders of like $250,000 each, of which you are authorized to okay. And before you know it, the contract is up to around $3 million. Oh, well, all because of amendments and change orders. Again, if there are very large unexplained price differences between bidders, if you're seeing a pattern where one bidder is always submitting the bid late, or repeatedly winning by narrow margins, or there's a predictable rotation of bid winners, okay? That thing with the cars at the auto pound, it was suspected that this handful of bidders were doing this scheme. So the way to get around it, what they did was they took a Chicago police detective, put a wire on him, a recording device, and sent him down to bid on cars. And so if their scheme was, okay, here's this, car that's worth $50,000, you get it, but you don't bid any more than, $2,000. Cool. And when they hit the $2,000 bid, the cop wearing the wire would bid more. And then he'd get the car. And then the next car comes up and, vendor B is supposed to get that one. And here's this Chicago detective, again, undercover, outbidding everyone until eventually the auction takes a pause and the four guys involved in this scheme surround this undercover cop and essentially spill the beans. They say, look, guy, you're ruining the scheme. He was supposed to get that one for no more than $2,000. He was supposed to get the next one for no more than $3,000. You keep outbidding us. Tell you what, we'll let you in on the scheme if if you'll go along with it. And he had each of the four essentially say on the recording exactly what their roles were and what they were doing. So yeah, that was a pretty good, easy case to prosecute. Okay, because they saw this predictable rotation in bidders. The other is losing bidders always show up as a subcontractor. Funny how that works. Again, the contractors submitted artificially inflated prices, knowing they would end up as subcontractors on the contract. If you get, a bunch of bids just below the favored company's bid, but the suppliers are fictitious, it's simply a way of making that bid look credible. Okay. Our qualified bidders fail to submit contract proposals. That could be that situation where they, published it in a, unknown newspaper or had a real tight bidding calendar. And again, the splitting the large projects into a bunch of smaller jobs. Okay. Now, again, we say bribery is offering, giving, receiving, or soliciting anything of value to influence an official act. Several ways for a vendor to pay an employee to surreptitiously aid the vendor's cause. The old favorite is money. Here's a brown paper envelope with a bunch of $100 bills in it. Setting up slush funds that the, say, purchasing agent can have access to. As I said with the mayor of Portage, Indiana, you pay them a consulting fee, or you pay them a referral commission, okay, a finder's fee. Promises of future employment, and not just for them, but also for family members. There was an undersecretary of the Air Force some years back who got prime jobs for her two children with one of the big defense contractors as part of the bribe scheme. Promises of part ownership. Okay, liquor, meals, free travel, cars, and sexual favors. Again, out in the Hall of Governors, we've got one for George Ryan. Well, he was convicted of receiving vacations in order to process, I think this was when he was the Secretary of State, to award contracts. Transfers of property, paying off employees' loans or bills, offering of loans on very favorable terms like 0%. Or what's become easier is give the person a debit card. You can go to the store, get a debit card off the rack and load it up with money and give it to the person. Okay. And that way they, or give them a credit card, but the debit card loaded up is a much easier way of handling the bribe. Okay. What about the FCPA? Now, back in the era of Richard Nixon and Watergate, there was also uncovered that foreign countries were paying big bribes to American defense contractors. Okay. So what Congress decided was, okay, we're going to pass something called the Foreign Corrupt Practices Act. Okay. I know I had that backwards. I'm sorry. Defense contractors were paying big bribes to defense ministers in foreign countries in order for them to buy, our fighter jets. Okay, mostly it was fighter jets. There were some helicopters in it, but mostly fighter jets. So it was, hey, don't buy from the British, don't buy from the The Swedish, who now are big contractors, don't buy from the French, buy from this American company because we will pay you handsomely. Well, it caused quite a scandal, and it's not a good idea. So, Foreign Corrupt Practices Act was passed. It makes it unlawful for certain classes of persons and entities to make payments to foreign government officials to assist in obtaining or retaining business. Okay. Specifically, the anti-bribery provision of FCPA prohibit the willful use of the mails or any means of instrumentality, interstate commerce, corruptly in furtherance of any offer, payment, promise to pay, authorization of payment of money, or anything of value to any person. Why do we talk about the mails and such? Again, that's how we get it within federal jurisdiction. Okay, because the mails are a federal, federal jurisdiction. Recent years, FCPA enforcement has been rigorous, using sophisticated investigative techniques such as industry-wide sweeps, undercover sting operations, and penalties for violations of FCPA can be harsh. Okay, a couple of things. Number one, the easiest thing for a company to say is, hey, that was bribe was given on the other side of the world. We didn't know this was going on. Okay, the answer to that was, well, you should. So the FCPA is very important for accountants and auditors, especially, in that this was the first federal law that essentially required internal control. So companies had to have sufficient internal control so that if one of their salespeople on the other side of the globe was offering a bribe to a defense minister, you would know about it, or you would have some indication it was happening, and then you could shut it down. Just saying, "Oh, how was I supposed to know what was going on?" is not an excuse under the FCPA. It's you knew or you should have known is the standard use. So this law is important because it's now required companies to put in good internal controls. As we'll see after the Enron scandal and then the passage of the Sarbanes-Oxley Act, even more so, companies had to maintain good internal controls. Secondly, FCPA enforcement under the current administration has been given a low priority. Okay, so we're not seeing a lot of cases coming out of the Department of Justice under the current administration. Penalties can be harsh. Now, a company, so employees of the company involved in this can go to prison. The companies themselves, you can't put a company in prison, but what you can do is debar it. That is to say, they can no longer do business with the federal government. And if you're something like a defense contractor, that could put you out of business. Okay, so there's some very harsh penalties that can be both to the individuals involved and to the companies involved if they don't comply. So reasons for FCPA, it's needed because there's a lack of transparency and accountability, especially in some developing nations, poor regulation of political contributions, low public sector wages in many foreign countries, weak enforcement of laws and regulations by international governments, excessive discretionary authority of public officials. And in fact, that third bullet point, one of the problems that emerged immediately after FCPA was this: there are parts of the world where the procedure in many instances was, and I'll just give you one, where the port authority, okay, the chief in charge of a shipping port, would have a salary of zero because everyone knew that ships' captains would go into their ship's safe and pull out some cash, take a little, small boat to shore, go into the office of the chief of the ports and hand him a big bribe. And as a result, he'd get the authority to bring his ship to the dock immediately, and then their folks would be there to start unloading the ship. But you don't pay the bribe to the head of the port. Your ship will sit out there at anchor until you wise up. Okay. So shortly after the passage of this, a lot of ship captains says, look, I don't want to get in trouble by paying a bribe, but I can't get my ship unloaded until I do. And a lot of shipping companies ran to the Department of Justice, and DOJ said, okay, tell you what, go ahead and do it, pay what you think would be an appropriate price. And then Congress got involved and amended FCPA to allow it in these situations. So, it's do we tell people on the other side of the world how to conduct their business? Generally not. Sometimes we do. But here's a situation where our ships were not getting unloaded until we paid the necessary bribe. Okay. Oops, it didn't. There we go. So what kind of things are covered by FCPA? Of course, everyone's favorite, cash, checks, financial instruments, gifts, travel, entertainment, hidden ownership interests, loans, credit card bills, transfers at less than fair market value, employment, benefits like healthcare, college tuition, credits and reduced prices, charitable support for organizations associated with officials. All these things in the past have been used as ways of bribing foreign government officials. How do you facilitate payments? In general, the FCPA does not apply to a payment made to a foreign official, political party, or party official for the purpose of expediting or facilitating the performance of routine government action. This is the amendment that was put in to get our ships unloaded. So expenditures paid to expedite the following generally are not violations: obtaining permits, licenses, or other official documents to qualify a person to do business in the country, processing of papers, providing police protection, mail pickup, delivery, inspections, and as I say, they don't list it here, they should, unloading ships. Well, our friends across the pond in the UK said, well, that's good, America. We see what you've done. And a couple of decades later said, well, we'll do you one better. So they passed the UK Bribery Act of 2010, similar to FCPA. It applies to bribery of public officials as well as those in the private sector. Okay. The act also provides for jurisdiction over an individual conducting business in the United Kingdom. Okay, that makes sense. It's a UK law. Regardless of where the underlying act occurs, no exceptions for facilitating payments. So there's none of those facilitating payments outs that we just saw in the last slide. But what very often the UK Bribery Act is, this could occur if okay, the UK Act provides for jurisdiction over an individual, it should read this, who conducts business in the UK, regardless of where the underlying act occurs. So let's say you're an American company and you do business with the UK. That's great. But you also do business with, let's make up a name of a country, the Republic of Cressy. Okay, and the Republic of Cressy, it's well known that the Prime Minister of the Republic of Cressy takes bribes. And you don't get any business in the Republic of Cressy unless you pay the Prime Minister a bribe. So your American company pays Prime Minister of the Republic of Cressy in order to do business in the Republic of Cressy. The UK is not involved at all. But under the UK Bribery Act, the UK says, whoa, a second. Your company also does business in the UK. That's all you need to do to fall within our jurisdiction. So you do business with the UK, be on notice that anything you do elsewhere around the world that involves any other country, doesn't have to involve the UK, but you do business with the UK, so you have stepped into the UK Bribery Act. And so a lot of American companies have gotten caught up in this. They, started paying bribes to foreign officials. And a lot of businesses around the world have been caught up in this. They do, a German company does business in the UK, and then the German company also does business in, name the nation, Republic of Cressy. They pay the official in Republic of Cressy a bribe, and then the UK will step in and say, you have violated UK law. And you say, well, we didn't do it with our business in UK. And the UK says, doesn't matter. If you do business with the UK, you fall within the UK Bribery Act. So there's been some interesting cases coming out of this. All right. So red flags associated with a possible FCP violation. If that country involved has a decentralized management control, there are substantial payments going to agents, consultants, and other unspecified services. Payments are being made to offshore bank accounts in cash or wire transfers. Unduly complex legal or banking structures, unusual payments for commissions, loans, temporary employees, and director fees. Payments and wire transfers without chain of command approval. Payments to agents with unusual addresses. Payments in round dollar amounts. Unusually low or high profit margins on a project, and undocumented business entertainment expenses. All those things. Okay, how do you detect? How do you assess the risk? Talk to people. Interview employees. Do some data analytics, computer forensics. Search public records. Test transactions with a focus on high-risk accounts, marketing, training, legal, consulting, especially consulting. Audit transactions to ensure proper documentation for disbursements. Review contracts, including compliance with FCPA. And also just keep an eye in the news. If, when a foreign government official is taking bribes, they usually, this isn't going to be the first and only time. They're taking it from companies around the globe. Okay, so watch the news, keep your eyes open. We go to conferences with, folks with companies in other countries. Find out, is it known that the Republic of Cressy is known for accepting bribes? Okay, how anti-fraud efforts? Again, put in a code of conduct and make sure your people operating in or with foreign companies are aware of this law, of both laws actually. Monitor that tone at the top, that you're asserting ethical behavior. Establish anti-corruption policies and procedures. In fact, this one defense contractor that got caught up in this, one of the things they had to do was create a chief compliance officer role and fund it with top people and agents to go out and make sure that they don't, get caught up in an FCPA violation again. Maintain due diligence for agents and other business partners. Perform a FCPA risk assessment. Conduct annual reviews for compliance. Establish senior management oversight and FCPA compliance reporting. Develop FCPA anti-corruption controls. Institute FCPA training. Provide ongoing legal advice and guidance. Impose appropriate discipline for violators. And develop contractual compliance terms and conditions. All right. Now, illegal gratuities, economic extortion, and conflicts of interest. Okay. So we have bribery. That's the biggie. Then we have these as well. Illegal gratuity, which I've come to now start calling improper gratuity or illicit gratuity. Because since the Supreme Court case coming out of originally Portage, Indiana, some of these things might not be illegal, at least under federal law. A lot of states, including Illinois, have laws that make illegal gratuities, that is to say, a payment to an official after a contract has been awarded, illegal. But a lot of states don't. Indiana does not have such a law, for example. That's why the federal prosecutors got involved. So, an illegal gratuity is similar to a bribery scheme, but it's not necessarily intent to influence a particular business decision, but reward a decision after it's been made. Why? Because you're telling them, we liked playing ball with you. We'd be happy to keep playing ball with you in the future. You should be able to do your job without getting rewarded for, awarding a contract. Economic extortion. Employee demands a payment from a vendor in order to make a decision in that vendor's favor. It's common in bank loans. Okay. Where the bank loan officer says, hey, I'd be willing to authorize this, $2 million loan to your company. But, I really could use an addition to my home, and it would only cost $200,000. Okay. So you get the $2 million loan and you kick back $200,000. And you do it because if you don't get that loan, your business is going under. This was, if you remember, Alderman Ed Burke of Chicago. One of the things he was charged with was dealing with a Burger King in his ward that wanted to put in a drive-through. But in order to do so in Chicago, you needed approval of a zoning variance, which requires the approval of the alderman. And so he's basically saying, hey, if you want to keep your Burger King from going bankrupt or making money, you need that drive-through. You don't get it unless you award me something. And so it was the Burger King that got Ed Burke. So that's the, pay up or else extortion scheme. All right. Conflicts of interest. And that first word is the most important. Undisclosed economic or personal interest in a transaction that adversely affects the company. The employee must have employment interest in the vendor that submits the invoice. Any bribery scheme could potentially be considered a conflict of interest. Majority of conflict schemes fit into two categories: purchasing schemes and sales schemes. So again, you have an economic interest. Say you own, a lot of shares in a company, or you have a personal interest. You're the vice president of the company is your son, something like that. Okay. So the purchasing schemes, again, the mechanics of a billing scheme, conflict or fraudulent disbursement scheme don't change. The fraudsters also engage in bid rigging on behalf of their own companies. If the bill originates from a real company in which the fraudster has an economic or personal interest, and if the fraudster's interest in that company is, again, underlined, undisclosed to the victim company, then you have a conflict of interest. Not all conflict schemes occur in the traditional vendor-buyer relationship. As I say, you have the turnaround sales where the employee purchases the asset, like those photocopiers I talked about at that other university, and then resold it to the university at an inflated price. There we go. There's our conflict of interest scheme. A lot easier to see that one. Okay, take a look at that in your book. Talked about turnaround sales. Employee knows his employer is seeking to purchase a certain asset, takes advantage by purchasing the asset themselves, then turns around and resells it at the inflated price, pockets the difference. Sales scheme, either underbilling, so you sell goods or services below fair market vendor to a vendor with a hidden interest. Company and gets a diminished profit margin. So let's say your spouse opens a company that, let's say, a retail shoe store, okay, is selling shoes. You work in the sales department of a major shoe company. You sell shoes to your spouse's store at a very, very, very low price, okay, way below the market value. Company suffers a loss in their profit margin, but your spouse gets goods at a very, very favorable price. Or you write off the sales, okay? So they tamper with the victim company's books, you write off the amount owed by an employee's business. Maybe it's your business. You sell yourself stuff, and then you got that side hustle going. You have the company you work for sell your side hustle some stuff, and then you write off the sale because they're deadbeats, or you delay billing. But the writing off is even better. Okay, other conflict schemes. business diversion. You siphon employers' clients for your own business. You steer potential clients away from employers. I saw this up close with a law firm that I was at when I was in law firms, where a couple of partners in this one firm decided amongst themselves they were going to split off, start their own firm, and essentially take with them the clients of the old firm, the firm they were partners in. So while they were still sitting as partners in the existing law firm, they had solicited these, the biggest clients of that firm to come and join the new firm they were going to join. But they didn't, split off for months. In fact, stuck around until they got their year-end bonuses, and then took those bonuses, and the next were given out on December 31. And then on January 1, sent in letters saying, we resigned from the firm, and then sent out notices saying, we now started a new firm, send us your business, and all those folks they had solicited, sent them the business. So while they were working as partners to the first firm, they had a conflict because they had set up the second business. It turns out one of the clients that they took actually consulted with them as to the office space they were going to get, and arranged for them to get a loan from a bank. Okay, so that's not cool. Or you steer potential clients away from your employer and to that firm you have an interest in. Resource diversion: divert funds of their employers to the development of their own side business. Financial disclosure: management obligation to disclose fraud committed by employees in positions of trust. Inadequate disclosure can be among the most serious of frauds because you're not disclosing it. You should. Now, how do you prevent and detect it? Have it in your ethics policy, specifically addressing conflict of interest. The second one, the annual financial disclosure statement. As we've been saying from the beginning on this part, the key comes down to that word undisclosed. So disclose it. Fill out a financial disclosure statement and say, oh, by the way, my spouse is the vice president of this company that we do business with. He or she just got hired by them. Okay. And then the company will say, all right, well, then you will no longer be involved in any decisions that would involve contracts or whatever with that company. Fine. Again, I've been on a number of boards, boards of directors, and annually we have to fill out our financial disclosure, saying what companies we have interest in, we have stock in, things like that. It was always kind of sad because some of these corporations, I was on there because I was the financial fraud expert and the auditing expert. And so my other board members would be filing these, would come into the meeting with their disclosure statements, and they'd be like an inch thick, showing all of their holdings and all these different companies and all the shares they owned in all these different companies, where mine was about like 2 sheets of paper. Oops. But when there was a conflict situation at a board meeting, we would say voting on a contract, the board member who had the conflict would simply say, abstain from voting, okay, because of that conflict. Disclosing the conflict is the very best way of handling these things. Okay. Again, communicate with your employees regarding other business interests, establish anonymous reporting mechanisms, periodically run comparisons between vendor and employee addresses and phone numbers. Again, that sometimes actually works. And here, again, I'm going to leave it up to you to read over some of these big data and data analytic techniques. Again, they're very interesting, and you may want to keep these slides for future classes or for your future employment. Okay. ways of looking at data to look for and find red flags. Again, red flags only show areas that you should investigate further. It does not necessarily mean there is, in fact, fraud occurring. All right, the human factor. Okay. And it just lists a whole bunch of things of what folks are capable of doing, right, when they're pulling off a fraud. Sell people hope. And I've seen so many different fraud schemes where, and these some of the most shameful ones. And I'm thinking of, like, relationship fraud, where somebody supposedly is, has a relationship with another human, okay, something called romance fraud and such. Where you sell someone hope and then you dash them after you take their money. That really stinks. Again, keep making excuses for as long as you can. And you see politicians doing this all the time. I'll take responsibility, but I had nothing to, I knew nothing about it. So it sounds good that you're taking responsibility, but then there's followed by the word but, and then you blame it on somebody else. Except underlying facts is true, but then you rationalize your actions. But if you can't defend your actions, attack the messenger. And again, think of political things that have gone on in the news over the past several years, right? Really forever. Always show your kindness by doing favors. Publicize your good deeds. Build a strong base of support. You, the big boss, you take the high road and you let your surrogates do the dirty work, like attacking the messengers. When you can no longer spin, shut up. When you're placed under oath, and we saw this, just the last few days, you have selective memory, right? I just saw reports about Secretary Noem before the Senate, and can't recall all sorts of cases that have occurred under her watch. Keep your friends close, keep your enemies closer. And if you're under investigation, always say, I will cooperate, and then do anything but. Okay. All right. The human factor. What do we have to do? Establish clear and reasonable anti-fraud standards. But remember, if you set the standards too high, you may be inadvertently giving an employee two choices, to fail or to lie. Okay. Okay, I'm going to tell my story. Some years ago, a friend of mine who is an adjunct professor for another university asked if I would come in and be like a guest speaker in one of his classes. It was Professor Fraud. It was cool with the Governor State College of Business. Everything, you're allowed to do that. Fine. So I went, spoke, great. Then, as a favor to me, he had a fruit basket sent, really nice fruit basket, sent to my office at Governor State for me to enjoy this selection of fruit. Very nice. Unfortunately, it didn't get delivered until late on a Friday. I had already left campus. This was pre-pandemic, so when folks were actually coming to campus. And I had left campus for the weekend. And I get a call. In fact, I was in my car driving home. I get a call that this big fruit basket just got delivered. You want to come, turn around and come back? And I was like, no, I really have things I wanted to get done this weekend. Go ahead, open it up. Let anyone who's still up there in the College of Business come in and take whatever fruit they want. And it turns out, yeah, the fruit was grabbed up. One person even took the basket. Okay, it was supposedly a nice basket. Cool. Excellent. Thank you. What I didn't realize is that Governor State, when something like that comes in, the folks in the, I guess, mail room take a picture of it, get the name of the recipient and the name of the sender, and send it over to our ethics officer. And I think at the time you were allowed to accept gifts up to like $75 or $100. I'm going to turn my camera on to tell you this story. Okay. Yeah, $75 or $100, something like that. Again, this is some years ago. Well, you're not allowed to take gifts, okay, really have any amount, if it comes from a company that does business with the state of Illinois. Fine. Fortunately, my friend, who was the adjunct professor, who invited me to speak to his class, which I had permission to do, he worked for a consulting firm. And I got notice that, hey, you may have violated the ethics rules. Oh, okay. So I called my friend. Does your company do any work with the state of Illinois? No. However, it turns out that his firm is actually a subsidiary of a bigger firm that had a subsidiary that did work with the state of Illinois. And thus, by conclusion of the ethics people, my friend does work for the state of Illinois, even though it was the other company over here but they had a common parent. Okay. And the ethics people went so far as to look up what the retail value of this fruit basket was from the company that's sent it. And it turned out to be like $105, just over that $100. So I was given a choice, saying, well, under the rules, these are state rules, and I'm a state employee, I can either, one, give the gift back. Well, that's going to be kind of hard because it's now the following week. The fruit has already been distributed, probably eaten. Even the basket was gone. Or you can make a contribution to a 501c3 charity for the amount of the value of the gift. Asterisk. By the way, the Governor State University Foundation is a 501c3 charity. So I had to write a check to the Governor State University Foundation for the amount of a fruit basket that I didn't even get a banana out of it, okay? But them's the rules. And I've seen this elsewhere. The Joe Wells, who founded the ACFE, was an FBI agent, and they had, some rules that were just ridiculous as to expenditures. When I was working with the Air Force, Department of Defense has got some great rules. They don't want bribes being given, but some of it was just silly. I remember at one point we were out to a fancy dinner. I said, well, tell you what, let's order a bottle of wine. They go, no. Because if we do, then we have to measure out how much wine each person has, and then, pay you that. I was, okay, we're not measuring out how many glasses of wine. So sometimes, again, you get in a situation where you're given this choice. You either, you fail or you lie. So make your rules reasonable. Okay. It's like, you can't accept, gifts from anyone who does business with. Well, come the holidays, people like to, especially if they're on good terms. They're like, here, have a box of, Fannie Mae candy. Oh, no, that's a bribe. No, it wasn't meant to be a bribe. It was meant to be, a friendship gift. So put in amounts of, what you can give, what you can't. As I say, with the university, with the fruit basket, I think because they were through this convoluted thing, a contractor with the state, no amount, okay, was too small. Anyhow, so human failings is what lead trusted people to violate trust. One of the things I talked about recently, and it's now been posted, and the podcast that I did when I was in Washington, is one of the good things about auditors is an auditor, the presence of auditors will deter people from, violating compliance rules. Not because they want to violate a compliance rule, but because it's kind of human nature to cut corners. If you don't really know why you have to do all this stuff, you got to cut a corner. Put an auditor in there, might get caught, better not cut a corner. All right, even though I think it's silly, I'm going to keep doing it. All right, human failing. No one factor alone will deter occupational fraud. Because, things like greed, payment of wages in kind, okay, they owe me the money anyhow, so I'm going to get out my wages in kind by, stealing the money this way. Or you're set up, to try and achieve some unreasonable expectation. All right. Again, we talk about, in understanding fraud, deterrence. We talk about prevention. That removes the root cause of the problem. That's great. But deterrence is playing with people's minds, okay? Modifying behavior through the perception of a negative sanction. Again, as I point out in this podcast, our income tax system in the U.S., for the most part, is voluntary. We expect you to pay your income taxes and to file a 1040 by April 15th or get an extension, right? But then eventually file it. What makes people do it? Because the IRS has got these auditors out here, and if I don't, I could get in a lot of trouble, okay? Again, fraud offenders are easier to deter than run-of-the-mill street criminals. Run-of-the-mill street criminal, it might be a crime of passion. You don't see that fraud. It's more calculated. As I like to say, it's an economic crime. One moment. Oh, sorry about that. I turned off the camera. I meant to turn off the microphone as well. Wait, I'm now going to do it for the second sneeze. There you go. Got it that time. When I was doing my radio program on WGN radio, they on the control panel in front of you, they have a big button labeled sneeze. So that if you did sneeze, or you're going to, you hit that button, you sneeze, and then you came back on the air. Nobody wants to hear somebody sneeze, and I apologize for not turning off my microphone fast enough. Again, fraud offenders are easier to deter. They're very deliberate. As I like to say, they're economic criminals. They weigh the costs and the benefits. And thus, fraud offenders' conduct is easier to modify. So, what about controls? Well, accountants and auditors generally expect controls to do too much. Many controls have nothing to do with fraud. Sometimes they're just silly, but sometimes they're not, okay? Some controls are only indirectly related to fraud, and controls are only part of the answer. The perception of detection, okay? And I told you all about putting the dummy closed circuit TV camera in the back of the computer room, and then suddenly the thievery from the computer room stopped. Employees who perceive that they will be caught engaging in occupational fraud and abuse are less likely to commit it. So what do? Well, have a open forum where you talk about these things. A lot of employers are like, well, we don't want to talk about fraud. They'll give our employees ideas. And I would say, who are you hiring? Actually, better to talk about it. Let them know that you're watching. Let them know that you're not going to outsmart us. We're on top of it. And then they also know what to look for if they think someone else is committing fraud against the company. Again, if not handled correctly, it can cause more problems than it solves. So 6 steps to increase the perception of detection. Again, employee education about fraud. Proactive fraud policies. Give it a higher stance. Make it known that we are constantly on the lookout for this. Increase the use of those analytical review and data analytics. Where feasible, surprise audits. Oh, people don't like those. You show up and go, we're here to count the cash in the petty cash drawer. Well, you were here, 6 months ago. Yeah, we're here now. And then have adequate reporting programs. So if somebody suspects something, they will have the ability to report it. And so reporting programs should emphasize, again, fraud, waste, and abuse occur at some level in nearly every organization. The problems cost jobs, raises, and profits. Oh, you tell people, hey, this may cost you your raise this year or your bonus. Hey, show an interest. Organizations actively encourage employees to come forward with information. There are no penalties for furnishing good faith information. Again, it has to be in good faith. You should have an exact method for reporting. Don't just say, "Oh, come forward." Have a method, a hotline phone number, a mail address or an email address. Okay, even a phone number you can text to. Great. And remember, a report of suspicious activity does not have to be made to the employer's immediate supervisor. They should go at least 1 or 2 levels above, or again, to a company-wide hotline. Okay, and there is that chapter. Moving on.